economy. So I'm naming this presentation The End of Capitalism, and it sounds dire, and it really is. Again, I barnstormed around the country last year giving speeches all over really, and they were, I would say, not uplifting. In fact, they were scary as hell. And I just continued to do it because I wanted to bring to audience's attention and to the world's attention the risk that I foresaw in the economy. So I'll tell you that COVID-19, they call it a black swan, I'll call it a spark, but the dynamite was a sheer record amount of debt in the system. The system is engorged with debt, and it has been, and it's been building for a decade. So I'm going to go through in charts how we got here and where we are. And then I'm going to project a little bit on where I see us in 3 months, in a year, in 3 years, 5 years, and 10 years. I think this is going to have a generational effect, honestly, and it's really, really big. So that's why I decided that I would have this webinar. So I hope everybody's safe, and taking care of themselves during this period of time. I will say one thing I've been very impressed with during this COVID lockdown. Well, two things. One is this self-quarantine thing has us self-medicating in our family like crazy. The other thing I've been impressed with is the number of texts and emails I get of little vignettes, memes they call them, where Americans have staged these hilarious little scenes, COVID scenes and Corona scenes. One of my favorite is, and you probably all have seen it, is the woman sneezing in front of the bus stop, and the whole crowd of people reacts, spraying themselves with she gets shot, actually. I think that's my favorite one. So, all right, without further ado, we have a big audience. Thank you for attending, and I'm going to try to march through these charts. My End of Capitalism presentation. You can see from this chart that that is George Smith and I, partners in Trustco Management, look for a lot of ideas in analyzing government economic policies and their incentive effects on behavior. We invest in some ways where policy meets price, and we invest differently. I've got a hedge fund, and I'm like a sniper. I'm looking for ideas long and short. I go out and find these ideas, and I try to make money directly on them, and I'm able to take more risk than George. George manages wealth for families, foundation assets. He has a different view of things. Again, I'm the sniper, and I go out and find ideas with my 50 caliber gun, and then I report back to George, who basically is the rest of the military, and he decides how to execute the war, if you will, the crusade for his clients. And that's kind of how we work together. We work from a similar research framework, but we invest in different ways. He's very focused on risk management, the profile of his clients, their risk tolerance, their needs for returns. And I'm more looking for the action and trying to bring in returns through a more dedicated and focused approach in a long short hedge fund, which is called the N3L fund. N3L stands for Newton's third law, which is for every action, there's an equal and opposite reaction. So we look at government policies and their incentive effects on behavior. We look at fiscal policy, as you can see there, regulatory policy and trade policy. And today I'm gonna deal with monetary policy, because I believe that liberal monetary policy is what got us where we are today. It created the backdrop for the crisis that we have here. Without the Fed, without monetary policy, liberal and loose monetary policy, we simply wouldn't be here. If I could wave a magic wand and make a solvent world where the companies that are engorged with debt and the governments that have too much debt didn't have too much debt, in fact, they were flush with cash, we wouldn't have a crisis like we have right now. So I'm going to basically try to draw that scenario for you. Forgive me, I got to get my little charts going. So this is monetary policy, one of Arthur Laffer's 4 grand kingdoms of economic policy. And what we're seeing is unprecedented global central bank activity. This chart shows the bull market from the last crisis we had, the great financial crisis in 2009. And you can see the purple line is the S&P essentially. Every time the S&P declines by any amount, the Federal Reserve runs into the rescue with a new program. ZIRP stands for zero interest rate policies. You might remember in late 2008 when they enacted that. And then TWIST, Operation TWIST, where they were exchanging short-term assets for long-term assets on bank balance sheets. Then in 2012, by the way, when we weren't in a recession, GDP was growing a little over 1.5%. It wasn't a disaster. It wasn't strong. That's true, but it was not a recession, and it wasn't a crisis. And yet, Janet Yellen, or excuse me, Ben Bernanke, decided that we would embark on quantitative easing, and quantitative easing is where the Fed uses freshly printed money to go out and buy bonds, treasury bonds, and other bonds off of bank balance sheets, thereby injecting fresh money into the economy with the desire to increase risk taking. So essentially what they did was to address the debt crisis of 2008 when households were engorged with debt. They basically created more debt. They incentivized companies to take on more debt. And that's what quantitative easing did. And again, I want to emphasize that they did it during a period when we weren't in a recession. So usually when times are good and we are not in a recession, the federal government reduces spending and it reduces its deficit. It uses the good times to bring down the deficit so that during the bad times they have dry powder to address the crisis. That's not what they did during this period of time. The budget deficit increased, and in fact, to record levels. So when we hit the COVID crisis, we were not prepared at all. So go to the first rate increase there. That's when Janet Yellen projected to Wall Street and to the capital markets that she was going to start raising rates for the first time from practically zero. She did that. She raised a quarter point, and then the markets fell. And it was December 15th of 2015 when she raised rates the first time. And you can see that little purple chart, that little purple dip there. After her first rate increase, and the market fell about 10% violently. And then she said that's when we call it the Yellen pause. She basically apologized, said she was moving too quickly, and that she wasn't going to raise any more. And you can see where the S&P rallied from there. You see where Trump was elected. That's inconsequential to my story, but I thought I'd put it in there. And then you get a new Fed chief by the name of Jerome Powell, Jay Powell. Jay Powell came into office as a hawk, which means that he wanted to normalize rates. He wanted to raise rates and shrink the Fed's balance sheet. A policy, by the way, that should have probably been embarked on earlier, back when Yellen was embarking on QE in 2012, when the economy was not in bad shape. That's when they might have normalized their policy, but they didn't. So he comes into office a hawk. He starts to raise interest rates in 2018. You might remember when he said at the end of 2018, I guess it was December, when he made this famous speech where he said Fed rate increases were on autopilot. So interest rates were going to go up a quarter point periodically, and he was telepathing to the market to be prepared for that. The market, of course, fell dramatically in that December of 2018. And it was the worst Christmas Eve I can ever remember. The market was down 300 or 400 points. And then you can see where it says Fed pivots, that arrow. That's when Jay Powell got religion and reversed his autopilot notion. It reversed his notion that he could normalize interest rates. And it basically woke him up to the fact that the Fed's painted in a corner. I wrote an article right then in Forbes, which you can Google it under Thomas Landstreet in Forbes, and it's entitled "The Fed is on a Razor's Edge." And it described all of this, how he was painted in a corner and how they could do nothing but liberalize from there. In other words, they would never be shrinking the balance sheet and normalizing interest rates ever again during our lifetime. And so I made that prediction in February 2019. Well, clearly it's come out to be the case. So anyway, the Fed pivoted there. And by the way, when he reversed, it was quite dramatic. You can see where it says the arrow says Fed pivots. You can see the S&P rallied significantly from that day. I think it was fascinating that he had Janet Yellen on one side of him and Ben Bernanke on the other side of him when he made the announcement. So he needed some friends to support him. It was such a dramatic shift for him. You can see where the S&P resumed its upward momentum. And then in the summer of 2019, Powell actually completely reversed and started cutting rates. And he cut them several times in the summer. Then you had a little hiccup in September of 2019 when we had the little repo crisis. I won't go into it, but it was the first sign that we were going to face a liquidity crisis in due course. And that's when the Fed actually started buying Treasury bonds again. They resumed QE. They insisted, by the way, that it was not QE and that it was only temporary, but they embarked on another quantitative easing program where the Federal Reserve, with newly printed money, started buying $60 billion in Treasury securities a month. That's out of the system, out of the market, off of bank balance sheets from the JP Morgans and the Goldman Sachs of the world. 60 billion a month, 5 or 6 months in, they're at $350 billion of quantitative easing, all the while telling us that it's not quantitative easing. Don't worry, we'll normalize, we'll get there. And then, of course, you have the COVID crisis. The COVID crisis, as I mentioned earlier, was just the spark. The system that was engorged with debt was the dynamite. And if we didn't have a system engorged with debt, we would not be where we are, which is unprecedented in every single way. And you can see that last dip in the market is the most recent one, the COVID dip. And then there's my arrow that says move over capitalism. Because the Fed and the government is literally taking over large swaths of the economy as we speak, and we will be left for generations with the result of this. By the way, at the end of this presentation, I'm going to take questions. So hopefully I'm not going over your head. I'm trying to race through this. So when I say engorged with debt, a system engorged with debt, here's what I mean. 60% of NASDAQ companies have junk bond rated debt. And it's a record. It's a record in terms of the number of companies. It's also a record in terms of the aggregate amount of debt. So during that 2009 to 2018 period of time when the Fed was loosening, was keeping interest rates low, was injecting new money into the system by way of the quantitative easing programs, what they were doing was incentivizing companies to take on debt. And by the way, they were incentivizing investors to take on more risk. In fact, it was impossible to buy a treasury bond and make any money because the yields were so skinny, were so small. So investors, desperate for yield, went out on the risk curve and started buying other debt, that is, corporate bonds. And a lot of them were junk bond rated. That was the only way you could get any yield. The Fed did that purposefully in order to create a situation where companies and investors would take on more risk. And in the end, we woke up with 60% of NASDAQ companies with junk bond debt, a record. And by the way, a lot of those companies aren't even profitable. So we had a house of cards coming into this COVID period. Another amazing thing is, unfortunately for lenders, there was a record amount of covenant light loans issued during that period. So not only did you have 60% of NASDAQ companies with junk bond rated debt, a record, you also had a record amount of those loans in a type of loan called covenant light, where there's really little recourse for the lender. This is almost like back in the housing crisis when you had no doc loans. When a borrower who wanted to buy a house in Brentwood, Tennessee, or Alpharetta, Georgia, or maybe outside of Dallas, these hot zones for growth, in housing development, they didn't even have to show proof that they had a job to get a loan. And by the way, they could get a loan for more than the value of the home, 120% loan to value, for instance, and run out and buy a boat and a new car. And they were doing that. So we have the equivalent of that that's been going on in the corporate debt side. So these loans are covenant light, meaning, again, very little recourse for the lender, very good terms for the borrower. This is just signs of loose credit. This is a sign of a debt binge. Next slide. The federal government budget deficit was approaching $1 trillion, which wasn't a record, but it was closing in on a record. This chart freaked me out. I had showed this chart throughout all my speeches last year. And now this number is about to go to $3 trillion. By the end of this year, the federal budget deficit, the annual budget deficit, the cost of running the government will be about $3 trillion. And by the way, the government funds that deficit spending by issuing treasury bonds to investors. And they expect people to show up at those treasury auctions, buy those bonds. They can raise that money and keep spending it. By the way, with 10,000 baby boomers retiring per day now and Social Security being tested like never before, you actually also have $1 trillion in deficit spending from NASA. I mean, from Social Security. In other words, they're sending out $1 trillion more in checks per year than they're taking in from payroll taxes. So what we have here is a giant and swelling budget deficit, which has to be funded by issuing treasury bonds. Who's going to buy them? No one. Oh, wait a minute. The Fed. The Fed's going to buy them. They're going to monetize the debt. They already are. When I mentioned that in September of 2019, Jay Powell embarked on quantitative easing again with a $60 billion a month treasury purchase program. All he's doing is monetizing that debt, buying that debt directly from the treasury, funding spending with new money. It's as if you all were all my members, let's say owners of my company, stockholders in my company. And I assemble you all on a webinar like this, and I come clean. I'm sorry, all of you, I've mismanaged this company. We have too much debt and we actually can't service our debt. But don't worry, I have a solution. A very good friend of mine is a counterfeiter, and he has agreed to produce $10 million of counterfeit money, and I'm going to pay down the debt that way. That literally is what we are seeing when the Fed prints money to pay down debt that has already been incurred for money that's already been spent. And I know what you're thinking. It's inflationary. Well, it might be. I'll get to that. So this is how it works. Up until the COVID crisis, the U.S. government, this is the term structure of U.S. federal government debt. A lot of it expires within the next 5 years, okay? And they were, they had to refinance about $11 trillion of debt over the next 5 years. Again, they do that through treasury auctions, trusting that there will be buyers of this debt, even though that debt, treasury debt, yields what, half a point now? The 10-year was what, 0.76. So they're painted in a corner here. They've got huge demand for raising money, and no demand for the instrument, no demand for the treasuries. So they're really in a pickle. This is just QE4, which is quantitative easing. Remember, I told you that when Jay Powell embarked on his $60 billion a month treasury buying program, he said it wasn't QE. Well, it is now, if it wasn't then. This is just a chart showing how significant the Fed's treasury purchases are now. That orange line is QE4. The other ones are the little brothers, the cousins, the predecessor programs that were embarked on, as I told you before in that chart, by Janet Yellen in 2012, in 2013, and 2014. In other words, it's many, many times bigger. This next chart just shows the Fed's balance sheet. It was $1 trillion in 2007. After the 2009 crisis and the giant bailouts and the QE4, the QE program and Operation Twist, it grew to $4 trillion, a record by far. And now it's projected to go to $9 trillion. They're literally going to own everything. They're buying everything. Right now, they're buying corporate debt. They're buying treasuries. They're buying mortgage-backed securities. And guess what? They want to buy stocks. They want to buy stocks now. And if the stock market wasn't rallying, I promise you they would. In Japan, they've done this. The Bank of Japan, which is just like our Fed, it's a central bank, they actually own over 50% of the stocks in the Nikkei index, 50%. The Japanese central bank balance sheet equals their GDP currently. So there's the model, there's the predecessor, and that's what the Fed is looking at, and they realize that Japan has not gone under. It's not under the ocean. It's not falling into the sea. So maybe we can do it too. And I would argue that there's a tremendous amount of risk to that thinking. It's like modern monetary theory thinking, MMT, which I'm sure you've heard about. So now we have $24 trillion of treasury debt outstanding. And you can see this chart goes back to the 70s. And you can see that in 2009, that gray area, it's a recession. All the gray areas are recessions. You can see where the amount of treasury debt just took off. And so we don't have this updated, but of course it's skyrocketing from here. This is a weekly change in Federal Reserve assets. So this is a sign that the Federal Reserve is currently, with newly printed money, buying everything they can get their hands on. They are determined to put a floor in the equity markets. And you can see by today's action, yesterday's action, the day before, that they're doing it. They're forcing one of the greatest short squeezes in the history of the world. They are intent on stopping this market liquidation, this market meltdown. They are absolutely intent on preventing a depression. And they're risking everything in doing it. By the way, they're doing the same thing in Europe and around the world. There's $16 trillion of what they call sovereign debt. This is debt issued by countries. It's got a negative yield. So I got a great opportunity for you all. You can buy some negative yielding debt. You put up $1 million, you buy $1 million worth of European debt, call it German debt, put up $1 million, and you can actually get $960,000 back. That's the kind of deal I'm talking about. And by the way, with the 10-year Treasury bond at 0.76, when you adjust for inflation, that's a negative yield currently as well. So why are they doing that? They have no choice, but they're also trying to create risk-taking, amazingly, at this point. This is money supply. And a fascinating story. This is just money in circulation, okay? Money in circulation printed by the Fed. Look closely at this chart, okay? The gray areas, again, are recessions. Look at the recession after the 2000 internet bubble popped in 9/11. You can see the blue line has a little blip there, a little bitty gap up and then gap back down. And you can look along the chart, you know, in past history, and you see that that's an extraordinary little blip relative to the history. And that was when they opened up the central bank activity to make up for the crisis that happened after 9/11, to make sure that banks and companies had enough liquidity after we were attacked 9/11. Up until that period of time, that was an extraordinary move by the Fed. It was very big. It was the biggest ever. But of course, you can see that it's absolutely dwarfed by the money supply growth that follows the 2009 great financial crisis. You can see over to the far right of your screen a little blue line that gaps up. That's just the last week. The Fed bought $1 trillion worth of securities over the last week, okay, with new money, remember? So when you have any kind of market for anything, and you have an incremental buyer step in within a week's time with $1 trillion of new money to buy anything and everything, of course, you'll see the market firm up. Of course, you'll see the market go up. This rally that we're seeing is 100% Fed engineered. Is it sustainable? I don't know. We're going to go through that. This is just people ask me, well, where are we going for here? Have we bottomed? Is there another leg down? Are we going to retest? Answer is, I don't know. The Fed is going to do everything in their power to prevent it, obviously. They are absolutely intent. They're red-faced about it. So we'll see. But right now, it's really following a path that was already set by the Lehman meltdown in 2008. The black line, obviously, is the S&P during 08 and then 09. And the red line is the current decline through the fall of last year. This recent fall, sorry. So this is this year. The red line shows the recent collapse in the equity markets. and you see that this rally kind of looks like the same type of rally that we saw during the Lehman crisis. So the answer is, yeah, we could go back down, and there's a pretty good chance that we do, because the depression that we're facing is pretty significant. And I use the word depression not because I'm being flippant or loose with words. It's because we actually have one coming. So this is it. The Economic Cycle Research Institute, the ECRI in our world, people that are in, on Wall Street, they have probably the greatest record of predicting recessions of any of the various groups out there that predict such things. The green line is, their weekly leading index, and you can see where it's collapsed. In fact, it's at a record low. So they're predicting, it looks like, down 30% GDP growth in this chart. I mean, it makes me sick, but it's obvious. Nobody's doing anything. I haven't left my house, in days. I'm not using gasoline. Unfortunately, I'm not even buying toilet paper. There's none available. I've been looking, and in fact, I've got a little. I'm going to put a bid out for some toilet paper after this presentation. Just kidding. Earnings per share revisions. This is just Wall Street firms and their bogus expectations for earnings. They're not over. The expectations for earnings declines are really just getting started. There's a lot more to go. And you can see in these dips with the red circles during past crises, we're going there and we're going further than any of these little dips that you see there. So the damage is not done when it comes to earnings. Unemployment flying. We had an unemployment number today. It was tremendous. Could be 32% of the population is unemployed when this is done. That's what the Fed's trying to address. It's a crisis of epic proportions. In fact, it's worse than the Great Depression, as you can see here. The economic downturn is going to be bigger than the Great Depression. The numbers are going to be bigger. The unemployment numbers are going to be bigger. And that's exactly why the Federal Reserve, the Treasury, and the government has a bigger response than we've ever seen in history. This is a period of superlatives. This is a period of record statistics, record unemployment, like I said, record downturn, record debt before, and now a record policy response that's going to leave us, I believe, in potentially much, much worse space. Somebody texted me that they have some toilet paper for sale. Whoever that was, can we deal with this offline? Thanks. Anyway, unemployment insurance. Here's what they're doing. One of the things they're doing, they're paying people not to work. I got a friend of mine with a giant food service business. He employs over 500 people. He's had to shut down his operation, and he's had to let these people go, a lot of them, let them go. But guess what? They're making more money being unemployed than they were with him, and he actually pays pretty well. They're paying people not to work now. The incentive now becomes to not work. So when you pay people, as Art Laffer, my old boss, used to say always, when you pay people not to work, and you penalize people who work, don't be surprised when you'll have more people not working. So the subtle friction of these unemployment programs is they're incentivizing people not to work. They're paying them more for not working. When we do restart this economy, when we do try to open up all these businesses and bring back their customers, how do we go out and find these employees when they're making more money on the dole? I'm telling you, it's going to take a lot longer than people currently think, precisely for that reason. Trade. So I'm going to get into a little bit of inflation, because that's the question I'm being asked by so many people. Is this inflationary? And the answer is, I think so. So when we look at inflation, Milton Friedman's great equation for inflation is it's too much money chasing too few goods, okay? We know we've got too much money. We've had it. But we've not had too few goods, right? We've had the China effect, where Walmart was buying, tons of cheap merchandise manufactured by China and bringing down the prices of almost everything for us. And it's been tremendously beneficial, honestly. I'm not going to go into whether China's a bad actor. I'm just telling you that whole trend was disinflationary. Okay, it brought down broad prices. There were other things at work as well, by the way. There was all this cheap money available, that let companies produce goods in an unprofitable manner and keep operating. I mean, Uber is not profitable. Okay, they've come in with this service that's better priced than taxis, and investors are not requiring that they make money. So they're able to undercut the competition, and that brings prices down. Look at Amazon. They didn't make money for years and years and years and years. They could undercut the competition, which was traditional retail, and investors did not require them to make money at it. How would you like your chief competitor to be rewarded for not making money? That's exactly what happened. It was disinflationary. So you've had, of course, all this economic stimulus, okay, cheap money, easy money, that have allowed companies to continue operating without making profits. And they can underprice the competition with no discipline. It's brought down prices generally. That and the China effect. So looking forward, I'm telling you, a couple of things are going to change dramatically. One is the credit crisis is going to prevent companies that aren't profitable from continuing operations. Oh, wait, it would have, with the Feds bailing them out. Lucky us. And then you look at China trade, and clearly the relationship with China's changed. It's probably changed forever. We do realize that they have been bad actors. They have stolen our intellectual property. They have ripped off our merchandise. And now we're drawing a line. And after COVID, I don't think it comes back. And I think that the free trade relationship that we had that led to cheap goods and services in abundance is over. So that disinflationary driver is over. So prices could go up here. Gold. This is where I'm going. We look at today's world and we wonder, what do you own? And what do you don't own? Okay, well, looking back at the 70s, before I get into this chart, please. I'm looking at the inflationary period of the 1970s. You could own stocks. Stocks did go up. If you hit a chart of the Dow or the S&P, but really the Dow, who's a bigger index back then, more important index, you'll see that stocks went up throughout the 70s when we had wild inflation from 71 to the late 70s, 14% inflation per annum. Stocks went up. On a chart, they look good, but when you adjust for inflation, they actually went down. If you had $1,000 invested in the market in 1966, by about 1978, that $1,000 was worth about $300, inflation adjusted. But if you look at the chart of the Dow, it went up. So I guess the net result is you can't own stocks. That's true. They will go up precisely because the Fed's injecting so much money into the system. That money is like oxygen going into the bloodstream, and it's going to filter out into the capillaries, let's say, of the economy. And that's exactly what the Federal Reserve's trying to do now with all this money injection, is they're trying to force that oxygen well into the bloodstream and well into the capillaries of the economy, to small businesses and out there on the fringes. But the result is that you may have inflation as a result, especially with the two drivers I mentioned now being a thing of the past, and that was China and the disinflationary effect of cheap goods from China, and then the fact that easy money let companies undercut their competition with no requirement that they actually earn a profit. With those two dynamics changing and so much money entering the system, we do have the inflation equation, which has been reignited. Too much money chasing too few goods. And I think we could be there. So what am I doing? And what are we advocating? Well, we are advocating that people consider allocating to gold and precious metals. And the reason is because I'm not a gold bug. I've always thought gold bugs were bizarre, strange people, and they are strange people. But over the last year, when I have been analyzing the amount of debt we have, when I've been looking at the Fed's response, and I've been looking at the Treasury and the policy response, and thinking that even the trade war may tip us off into a recession, and a prolonged recession would be a crisis with this amount of debt out there, and there was a tremendous amount of risk in the system, I started sniffing around for what do you do to hide? Well, hard assets. That's one area that's always done well in an inflationary environment. Land, copper, maybe oil, which is down today, by the way. Precious metals, gold and silver are a great place for you to hide some aspect of your wealth. We advocate that wealthy people really consider this type of investment. This is exactly how gold behaved, by the way, in the last crisis. So this is, if you look at this chart, you've got 2008 until the present, and gold fell initially, like, by the way, it did recently when the market collapsed in February and then March. Gold and gold miners fell with it. But I will tell you, gold's been the best performing asset in the last 12 months, nonetheless. And you can see that it had an initial fall during the '08 crisis, but then it turned and rallied. And by the way, it rallied about 300% in just a few years. It took the economy a full 7 years to get where gold got within less than 3. So here's another crisis period. This is gold performance after the dot-com bubble. So in 2002, gold responded by going to 300 an ounce. It eventually capped out at about $850 an ounce. So obviously that is a 3x increase in from 2000, call it 2 to 2008, and again far outpacing the stock market. Even though the Fed was embarking on unprecedented monetary policy that many would argue would be inflationary after 2008. No, sorry. Yeah, here. Many people expected inflation, including my great old boss, Arthur Laffer. And they were perplexed that inflation never happened. And I think it's because of the two reasons I mentioned. You had the China trade scenario that was a huge disinflationary influence. You also had the easy money policies that were creating a scenario where companies could actually be rewarded for not making money, for undercutting the competition, underpricing the products. Without those two disinflationary influences, I think the table could be set for inflation. And so this is just an idea for you. It's kind of off the radar. I'm not a gold bug. I think it's fascinating. I think you got to do it. And by the way, today, gold broke out of a 7-year range. I think it's above 7-year highs today. And it's going to be the best performing asset over the next year, 3 years, 5 years, and perhaps 10 years. I think what the federal government is doing now with a $3 trillion annual budget deficit, a record by a far margin, that they're going to have to fund through treasury auctions and a Fed balance sheet approaching $9 trillion. These are numbers that are so far unprecedented that they were unheard of. They're so extreme that they're just not something we can not ponder. They're not something that we can take for granted. This is just not an everyday affair, business as usual. It's extreme, and they are risking the future. They're risking generational wealth. When you have a $3 trillion budget deficit, you're absolutely going to have to raise taxes. So let's say Donald Trump wins. He might. I doubt he's going to raise taxes, but the next president will. They're going to have to. I could see tax rates going up 50, 60% of income. So that too will weigh on the economic growth. This is going to be an albatross around our neck for years. So I'm going to go to Q&A. And I want to introduce my partner, George Smith, who's also online. So I might revert. He's in the audience, but I'm going to text him for questions because he often helps me out when you ask tougher questions that I'm capable of answering. So there are 100 fine friends of mine and ours out there. So thank you for participating. And I'm going to close with one little story, if you will. I always like to close with a story. And this is about an economics professor that was a professor at Vanderbilt. And he was a professed and proud atheist. One day he was walking through the Appalachian Trail by himself, deep in his thoughts on a beautiful, crisp day like today. Beautiful, stunning, beautiful day in nature. He's meandering along the path, deep in his thoughts, as professors often are. He hears a rustling in the woods next to him. He looks over, and a bear emerges. And of course, he starts running like a professor runs, which is it's not very quick. Knock-kneed, flat-footed, pins flying. Maybe he drops his calculator. Running as fast as he can, nonetheless. He looks over his shoulder, and the bear is catching him quickly. He stumbles over a stump, lands on his stomach, scuttles over to his back to see the bear upon him, claws fully extended. He's reared back a claw, and he's about to take his head off. Right then, the atheist professor, the economics professor from Vanderbilt, yells, "Oh my God!" Time freezes. The bear freezes. Time stood still. And a voice comes from the heavens and says, "Ha ha ha! You're an atheist economics professor from Vanderbilt. You've told thousands of students I don't exist. And now you're coming to me for help under duress. This is quite funny, I must admit. I'm quite amused." And the professor, realizing the irony here, was very squeamish, of course, uncomfortable. And he said to God, "Well, sir, I get that this is uncomfortable, perhaps for you and me, but I know it's too late to ask you to turn me into a Christian. But God, could you please turn the bear into a Christian?" God said, "Very well." Right then, the bear reanimated, reared back his hand again, and put his hands together and said, "Bless this food I'm about to receive." And that's the last story I got for you today. I know you're laughing in your living rooms. But anyway, we're going to go to Q&A, and I'm hoping that, oh, by the way, and I will have some more episodes. We will be doing this again. And I want feedback, and you can email it to me. If it's terrific feedback, I want to hear it all. If it's negative feedback, I do not want to hear it, and neither does George Smith. Please do not shower George with complaints, okay? It's tough enough being my partner without that. So if it's accolades, again, you got my email. And if it's anything other than accolades, please keep it to yourself. Thank you very much. I will do another episode, though, coming up, and I'm hoping that I've got some questions. So I do have a question, but it came to me by text. You've actually got a little question. You've got a little question bar there where you can text me a question, and I don't think anybody's doing it, which is shocking because I thought I was doing a riveting job. I do have questions, but they're coming to me by text. Can you golf Saturday AM? Yeah, I can. Gosh, that's goofy. Where was Peyton Green's question? Well, I can't find it. I do have one online, and I can't find it. I have to have my trusty assistant come here and tell me how to find this. Give me 2 seconds, please. There are questions. There's 6 of them. Where's Davis Hunt? Oh, I know. I got to get out of this. That's all right. I got questions. Other than going to gold, what else should our leaders do? Well, I'm not advocating our leaders go to gold, by the way. I'm advocating that we, citizens, go to gold. And the reason is because in response to our leaders. So Arthur Laffer had a very interesting idea for how we get out of this. And one of them is they ought to just give a payroll tax cut to employers and employees. That way the government is not picking winners and losers, okay, in this situation. Just give a tax cut for the whole year. Everybody benefits. And it creates an incentive, by the way, to work, not to go on unemployment where you get paid more money for not working. That's one thing. And how about cutting spending? Wow, that'd be radical. You know that there's 50,000 people in the Department of Transportation, and those aren't people with orange vests out that you see out on the interstate. They're in offices around the country. 50,000 people in the Department of Transportation. In other words, there's so much fat. I don't even know where to start. Hey, Bex, I'm running out of power. It's in the other room. And so that's one thing, quit spending. The other one is, how about that we change Social Security? If Brazil can do it, we can. You know, Brazil raised their retirement age by 3 years, okay? And they cut the generous benefits that government employees got and military personnel got. And suddenly the whole actuarial table changes. And Brazil, a Latin American country known for profligate spending and terrible governance, is actually doing what is necessary to save their fisc. And that's what we need to do. So there's 3 ideas, by the way. So what's my outlook for healthcare stocks? Oh my gosh, I can't go into that in this presentation, but I might do that later. And it's a great question. Okay, the ratio of silver to gold, another great question. Currently, silver is trading at a historic discount to gold right now. It's much cheaper. They trade in tandem, if you will. They're like kissing cousins. Silver's a better buy now than gold. It's cheaper, and it also has some industrial uses. I would not buy the ETFs. There's SLV, which is an ETF that's not that is arguably supported by gold. I mean, by the metal, but it isn't necessarily. There's PSLV, which is the Sprott version of the SLV, which is an ETF, SLV, PSLV, that actually has physical silver in I think the Royal Bank of Canada. So that's what I'd be buying. There's a gold equivalent. There's GLD, which is the ETF, but there's AAAU, which is the Perth, Australia version ETF that is actually backed by physical gold. I prefer those. And then, of course, precious metals equities are absolutely the best way that you can play this, precious metals equities. And we are there for you on that one. We manage a portfolio of those. I do. I've got them in the fund. And so precious metals equities are really the best way to take advantage of this. They're trading at like 3.5 times cash flow. The investors haven't found them yet, so they have no debt to speak of. They're growing. We just had one report in our portfolio, 40% growth in revenues today. And when I look out across the landscape, I do not see any industrial groups or sectors that are going to crush numbers this quarter. But let me tell you something, gold miners are. Why? Gold's at 7-year highs. It's a commodity play. They produce it. The cheapest gold in the world is in the ground. And so they've just got all margin. So it's a great group. Let's see. I got a question about the dollar. So yes, all these policies are bad for the dollar. In other words, they should weaken the dollar. But when you look at Japan, when you look at Europe, they too are embarking on these wild policies. So currencies are judged relative to other currencies. And when every country's devaluing their currency, what do you own? Precious metals. It's the only currency out there that is not a debt instrument. It's not a promissory note like a dollar or like currency. It's a genuine exchangeable store of value. So I think as a currency, it's what benefits the most. What other let's see, what equity sectors do I prefer other than gold? Well, the government is tinkering a lot. I like, I think that our conflict with China is growing, not shrinking. So I think defense spending will remain very high. I think that I like, let's see, what other areas do I like that? No, I got a whole list of them. Let me look, give me a second. I look at this every single day. Military, they're legalizing sports gambling legalization. Something like 17 states have legalized sports gaming, although there are no sporting events right now to go to. This is a very exciting growth area. And I like DraftKings and I like the Stars Group. These are two online sporting apps, and they're going to grow like crazy. I like, what else? Infrastructure spending. You know, they're itching to spend more money in Washington. They're just desperate to do an infrastructure plan. Today, Pelosi wants 2 trillion. Trump wants 1 trillion. It's just quibbling here, a few trillion here, a few trillion there. By the way, it'll be funded by the Fed. They'll print new money and they'll build infrastructure. So I like infrastructure names. Those are going to benefit substantially. Let's see, I'm looking, how much of your portfolio do you suggest investing in gold and hard assets? Great question. I think wealthy people should have a 5 to maybe 10% allocation to precious metals. I think it is, one, a hiding place. 2, it's a good place to avoid inflation. And 3, with the amount of risk the Fed and the Treasury and the government are bringing on through these outrageous programs, it is really a fabulous place to hide. Let's see. When is it advisable to begin transferring part of the 401k to gold? Right away. Depends on how big your allocation is. But if you got flexibility in your 401k and you can buy an ETF, buy PSLV or perhaps AAAU. Or gold miners. Like I said, they're trading at a modest multiple of cash flow and they are growing like crazy currently. They're very exciting. And by the way, I will tell you, gold miners have a bad reputation, and rightfully so. They haven't been the best management in the world over history, but they have improved the accounting standards substantially in this group. And so I think that as a group, they are healthier now than they ever have been. Oh, and by the way, did I say that they really don't have any any debt to speak of? They don't. During the last downturn, they rationalized their businesses. They cut debt. They took offline unprofitable resources. And now they've got growth ahead of them and profits like no other industry. I'm so excited about it. Question, will the market go down again or will the Fed prop it up? Answer, the Fed's going to prop it up. They're doing it today. Will it go down again? Perhaps. Remember, we're going to have an unemployment rate that's never been achieved in our country, unfortunately. We're going to have a GDP growth rate decline of perhaps 10% for the year. And I think Bernanke came out with a comment that they could be down 30% in the second quarter. So let's project out. What's it going to be like in a month or 2 months when the economic statistics come out every week and they're bad, bad, bad? ISM numbers, like manufacturing numbers, are weak. Unemployment numbers skyrocketing. Is that going to weigh on the market? Yes, it could. What do I want to own? As an investor, what makes me sick, my partners and I, George Smith, and my other partner, Garrick Moran, who, by the way, works on the hedge fund with me, we talk about what do we own today? And I know that the earnings growth is going to be terrible. So, I want to own quality. There's no doubt I want to own quality names without a lot of debt. Okay, let's start there. Good companies with little debt, good balance sheets, if you can find them. But the other thing is, who's going to have a good quarter? Where is it going to be earnings growth anywhere in the economy? And the answer is no, not really. So will the market go back down? Yeah, it might. The Fed is going to do everything in their power not to do it. For instance, I expect rating downgrades. I expect Moody's and the S&P to downgrade not only states and cities, but companies right and left. And they're already doing it. I think that the federal government is going to be, that our federal debt is going to be downgraded again. But you know what? The authorities are so intent on stopping this decline in the equity markets and stopping a depression, they may actually outlaw it. In other words, they're taking over large swaths of our economy as we speak. They're nationalizing our economy. And they are so aggressive, it absolutely scares me. We may not be able to see the truth. They may not let downgrades happen. And that's going to be terrible for the equity markets. And if that does happen, these markets are going down. What about short ideas? That's a great one. We have been shorting over-leveraged companies. That's one area. We have been shorting technology because they're severely over-owned. And that's about it. let's see. I think I'm probably close to an hour. Yep, we are. We're an hour in. What about Bitcoin? I'll answer that question. I don't know. I know young people think it's the cool thing to own and it's a surrogate for money, but it ain't gold. It's not gold. And so gold's what you own. Bitcoin's kind of cool. I wouldn't go down that rabbit hole necessarily. What about bonds? That's a great question. What about bonds? Look, if you're hiding and you're scared of the equity markets, you can own bonds, but you're not going to get much yield. How about the stocks of utilities? Utilities collapsed with the market decline recently, and great utilities like Southern Company and Duke, they had 7% dividend yields for a few days. They're still very high, and I think you can own you got to own things like utilities where the dividends are very high and very very safe, and that's a bond substitute. So that's where I would go for some of my bond portfolio, honestly. Um, and then Okay, so I'm going to do another one of these in a couple of weeks if you liked it, okay? And your feedback will tell me that. Once again, if you love it, you let me know. If you didn't like it, I don't want to hear it. I really don't. My ego's too delicate. Anyway, it's a beautiful weekend. Tomorrow's Good Friday. Sunday's Easter. I love everybody, and I am worried. I'll close it with my fact that I'll have a furrowed brow all weekend. Anyway, so thanks very much for your time, and I'm going to bid you adieu. Bye bye.